In ranging cryptocurrency environments, localized price action often detaches from fundamental news. Instead, these moves are driven by the mechanical unwinding of leverage. Decoding these movements requires more than a standard price chart. We have to map the underlying order flow using a liquidation heat map. This chart tracks two variables simultaneously. The vertical y-axis measures price, while the horizontal x-axis records the passage of time. The color intensity reveals the density of liquidation levels. The bright yellow and green bands pinpoint exactly where highly leveraged positions are most concentrated. High leverage clusters act as magnets because they provide the deep liquidity necessary to fill large orders. For a participant needing to buy or sell millions of dollars in Bitcoin, these clusters represent the most efficient point of execution. This chart captures that exact mechanic. A price spike moves directly into the bright yellow liquidity zone, sitting above 64,000 with calculated precision. We can map this process in real time by tracking a continuous sequence of Bitcoin price action across 5 days, from July 5th to July 10th. Mastering this data allows for a clearer assessment of market risk, identifying where price is likely to move next based on the location of the herd. On July 5th, Bitcoin was hovering in a tight, range-bound environment near the 63,000 mark. This heat map snapshot shows a heavy yellow band forming at 64,000, while actual price remains stagnant below it. This band grows as retail traders open short positions, placing stop losses just above local highs. The more who short, the denser this overhead cluster becomes. When price hits a short position stop loss, the exchange algorithm executes a forced market buy order to cover the trade. This creates an opportunity for institutional participants. Selling a massive block of Bitcoin in a low-volume environment causes high slippage, hurting the seller's final price. Instead, the price is often steered toward that 64,000 cluster. Once those forced retail buys are triggered, they provide the necessary volume for a large seller to offload their position without crashing the market. These yellow bands serve as a concentrated source of guaranteed buy orders, essentially acting as an exit ramp for institutional selling. Moving into July 6th, the price action accelerates. At 1500 UTC, an aggressive spike pierces directly through the 64,000 liquidity band we identified. After the sweep, the heavy yellow band vanishes. The liquidation orders have been fulfilled, meaning the liquidity at that price level has been consumed. With the overhead buyers exhausted, the price rejects downward, rapidly clearing the range toward the 61,500 level. As it falls, a massive new cluster forms underneath, representing over $35 million in liquidation value. This new band is built by late longs. These traders anticipate a bounce and place their stop losses just below the current price action. Having cleared the overhead leverage, the market's focus shifts to the newly established density below. By July 8th and 9th, market behavior shifts from sudden spikes to a methodical downward trend. The price now bleeds lower, steadily approaching the 62,000 region. This grind pressures existing long positions, while attracting new short sellers, who see the weakness as a sign of an impending crash. As price consolidates near 62,000, it presses directly into the liquidity bands formed by those retail stops. This phase ends with a final flush. Price lands perfectly on the 61,500 support band, clearing the remaining leveraged longs. These methodical, slow declines are absolutely necessary to rebuild the dense leverage clusters that will fuel the market's next upward expansion. Almost immediately after hitting the 61,500 zone, the price begins to bounce. During the hunt for the lower stops, new short leverage has accumulated back near the 64,000 level. With the downside liquidity cleared, the rally back toward the 64,000 target begins. By July 10th, the price breaks above 64,000, sweeping the upper cluster and resetting the board. This 5-day sequence demonstrates that market movement is often a bidirectional hunt, alternating between clusters of high-leverage stops. This sequence from July 5th to the 10th functions as a closed mechanical loop. Comparing the start and end of this cycle, price remained bound within the historical yellow zones we identified earlier. This confirms the core thesis: high-leverage clusters dictate the path of price. Without this data, these reversals appear arbitrary. When the heat map is overlaid, we see price tagging liquidity bands with surgical accuracy. Relying solely on candle patterns often obscures the actual order flow that governs price discovery. Placing stop losses at the most obvious structural points creates the exact liquidity pools required by institutional participants. Identifying where the majority of retail participants are positioned allows for a more accurate anticipation of the next sweep. In these markets, order flow and liquidity density provide the most reliable map for price direction.